value for the first year is 48.75. The second year is 70.31. The third year is 10.136. Then the fourth year is 10.962. So we are told that working capital is 15% on the sales value at the beginning of the year. Therefore, 15% of 48.75 is 731. 15% of 70.31 will give us 10.55. 15% of 10.136 is 15.20. Then 15% of 10.962 will give us 16.44. You will notice that working capital has increased from 731 to 1644. So meaning that you need to determine the incremental working capital. You need to determine incremental working capital. Therefore, the working capital in the first year of 731, that is what you have here. Okay. Then between 731, between the first year and year 2, so working capital has increased by 324. That is 731 minus 1055 will give you 324. In the second year, and between the second year and the third year, working capital has increased from 1055 to 1522 by 465. Between the third year and the fourth year, working capital increased by 124. That is 1520 minus 1644. That is what produced the 124. Then, of course, in the fourth year, 1644 minus 0 will give you 1644. Therefore, the rule says that working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. The working capital of 731 in the first year will be treated as cash outflow in year 0. The difference of 324 between year 1 and year 2 will be treated as cash outflow in year 1. The difference between the working capital of year 2 and year 3 of 465 will be treated as cash outflow in year 2. The difference between 1520 and then 1644 of year 3 and 4 of 124,000 will be treated as cash outflow in year 3. Then at the end of the useful life, you sum up all the incremental working capital, you sum up everything together, that's what produced the 1644. Then we are going to recover the 1644 at the end of the useful life. And that's what we have done here. Okay. So that's the working capital that you have here. The one in year 0 is this. Year 1, 324. Year 2, 465. We recognize the one of year 4, which is 124. We recognize it in the third year. They are at the end of the useful life, which is year 4. You recover the entire working capital. At the end of this, we need to calculate the net cash flow. So you sum up outlay plus the working capital of 731. That's what produced the 21,731. Then in year 1 also, you add up 1035 minus 259 plus 244 minus 324. We have 0.6. We have a 694. Then in the second year, 1918 minus 480 plus 244 minus 465. We have 1217. In the third year, 3131 minus 785 plus 244 minus 124. We have 2468. Then in the fourth year, 3162 minus 791 plus 243 plus 24,000 plus 1644. We have 28,252. So the next thing we need to do now is to go and calculate cost of equity on geared. Remember, we are calculating base case NPV. And the first step I told you that you are going to do when you want to calculate base case NPV is to calculate relevant cash flow or net cash flow. So far, we have determined the net cash flow. So the next thing we want to do is to go and do working for cost of equity on geared. So Before we go to our workings, we go back to the question. We go and identify the proxy company, information of the proxy company. When you look at the second to the last bullet point, that is where you are given information of a proxy. You are told that although no other companies produce yam pandas in the country, Cascare Limited. So you have seen a new name, which is Cascare Limited. Cascare Limited is different from Alcantara Limited. So Cascare Limited is a proxy company which produces cassava crushing machines, okay, using almost similar technology to that required for yam pandas. So now we are given the information of the proxy. Examiner told us that Cascare Limited cost of equity is estimated to be 14%. So examiner has given you cost of equity of a proxy. Remember what I told you. Whenever you want to calculate cost of equity on gear, it will depend on the information of the proxy company given to you. If you are given beta of a proxy, you identify the beta, you ungear the beta, you calculate cost of equity on gear, that is capping. Then step two, the second one is if you are given the cost of equity, just like in this case, we have been given the cost of equity of a proxy to be 14%. In this case, we are supposed to use the Miller and Modigliani formula to calculate the cost of equity. So if that is the case, let's go and calculate cost of equity on geared using Miller and Modigliani formula. It's so frustrating that my pen is not connecting, you know. In any case, yes, cost of equity on gear. This is calculated by using proxy company information. The cost of equity of Cascare Limited is 14% and it is geared. Therefore, calculate cost of equity on gear using the formula below. This is the formula for calculating cost of equity on gear using Miller and Modigliani formula. Okay, so cost of equity of a gear equal to cost of equity on geared plus cost of equity on geared minus cost of debt multiplied by the debt value multiplied by 1 minus tax rates over value of equity. So the cost of equity of a gear is 14%. That's what is given to us. We are looking for cost of equity on gear. We don't have it. That's what we want to calculate. Then the KD is the cost of debt. According to the question, you then go back to the where you have information of a proxy company. So according to this, according to the question, you are told that, yes, CL has 15 million shares in issue, okay, trading at 2.53. So to get the equity value, we are going to multiply 15 million shares with 2 naira 53 kobo each. Then also 40 million bonds trading at 94 naira 88 kobo per 100 naira. So now this bond of 40 million naira, ordinarily examiner supposed to attach the coupon rates of the bond, the interest rate of the bond, because the bond is not for free. So examiner supposed to give to us the interest rates, but the interest rate associated with this bond is not given. Therefore, where interest rates, where cost of borrowing is not given to you, or where interest rate, where the coupon rate is not given to you, you are going to assume the risk-free rate of return. All right. Where the cost of debt is not given to you, you assume the risk-free rate of return, because this bond of 40 million naira supposed to come with the coupon rate, supposed to come with the interest rates, but the interest rate is not given. Therefore, you are going to assume the risk-free rate of return of 4.5%, because you are told that the 5-year government debt yield is currently estimated at 4.5%. So that is the risk-free rate of return. Okay, the risk-free rate of return is the rate of return associated with government security. So, and that's why you are seeing that I assume 4.5% here, because we are not given the coupon rate on the bond of 40 million naira. So that's why you see this 4.5 here. All right. So now the next thing we want to do is to calculate the value of debt, value of equity. Okay, so let's go and calculate the value of debt. The debt is 40 million naira bond traded at 94.88. Okay, so let's go and calculate value of debt. All right, value of debt. What is that? Okay. Value of debt, value of debt. Where is the information on that? Let me see. All right. Okay. I think I have it somewhere here. To get the value of debts, what I did here, this 37, whatever, 3950. Let me see if I have it somewhere else. No. So how I
But
got the value?
you said earlier that we should multiply 2.53 by the 50 million.
Yes, that's what I did there. I just want to, I thought I did the working on in this document. So I was looking for the working, but the working is not there. I think is uh that skip. Let me just demonstrate that for you using my, so this 37952, what we did here, of course, the value of the bond is 40 million naira, which is 40,000. Our figures are in thousands. And the market price of the bond is 94.88. Therefore, multiply by 94.88. Bond debt is usually quoted at 100 naira per unit. Therefore, divided by 100. So that's what gave us the 37952. Then we go ahead again and calculate the market value of the equity. So market value of equity, we are told that the value for the proxy company, number of shares is 15 million. Okay, we have 15 million shares trading at 2.53. Let me confirm that. I think it's 2.53. Let me confirm. Market price of the proxy shares. Yes, 2.53 is trading at 2.532 naira 53 kobo. So in this case, what I did was to, of course, to get the value is simply number of shares. Value of equity is number of ordinary shares multiplied by share price. Okay, so the 15,000 multiplied by 2.53. That's what produced the 237,950. Let me confirm that. 15,000, figures are in thousand, 15,000 multiplied by 2.53. That's what produced the 37,950 that you have here. Then the tax rate of the proxy company, the tax rate of Cascade Limited is 28%. You have to be very careful here because you have used 25% for Alcantara PSA, Alcantara Limited. So you may think that the proxy company and the main company have the same tax rates, not knowing that you have a different tax rate. So because according to the question, the tax rate of the proxy company is 28%. Is 28%. So you have to be very careful. Let's confirm that. Yes, this is it. And it pays tax at 28%. So you have to be very careful. So the tax rate of the proxy company is different from the tax rate of Alcantara. The tax rate of Alcantara is 25%. The proxy company is 28%. So please be careful. Watch out. All right. So if that is the case, then our cost of equity loan here gave us, yes, talk to me.
Okay, sorry, could you please explain that D part again, that 37952? How we arrived at that figure?
The value of debt is calculated as nominal value multiplied by x int price. So the price, the market price of the bond is 94.88 and is usually quoted at 100 naira. Therefore, 94.88 divided by 100 will give you 0.9488. Then you multiply that with the nominal value of 15,000. Sorry, of yes, of is it 15,000? Of 40,000. Of 40,000. All right. So that's what produced the 379552. Okay.
Thank you.
Yeah. So to now get the cost of equity on geared, so you multiply the 37952 by 0.72. 0.72. Then you divide it by 37950. Okay. You are going to have 0.72. 0.72. Then, of course, that's 0.72. All you need to do is to expand. You need to expand this. All right. You need to expand the one in the brackets because all of these are together. You can't separate it. Therefore, this one is 0.72. 0.72 multiplied by KEU will give you 0.72 KEU. 0.72 multiplied by 4.5 will give you 3.24. We give you 3.24. Therefore, the next thing you need to do is to collect like terms. KEU plus KEU is 1 plus 0.72 will give us 1.72 KEU. Then 14 plus 3.24 will give us a 17.24. Therefore, to get the KEU, you divide 17.24 by 1.72. That's what produced the 10%. Okay, that's what produced the 10%. Therefore, cost of equity on gear is 10%. Cost of equity on gear is 10%. So let's go and discount the relevant cash flow. So this is the 10% here. In year 0, of course, is 1. 10% in year discount factor at 10% for year 1 is 0.909, 0.826, 0.76, 0.751, 0.683 for year 1, year 2, year 3, and then year 4, respectively. Then to get the present value, just multiply. You're already familiar with this. Just multiply with the net cash flow, and that's what produces the present value for each year. To get the base case NPV, just find the difference between the present value of cash inflow and the present value of cash outflow, and that's what produced the 1060. In this case, the base case NPV is 1,060,000 naira. That's how to calculate the base case. And you will notice that there's nothing changed in the way we normally calculate NPV and then this base case NPV. The only difference is just that you are using cost of equity on gear to discount the net cash flow. That's all. Now that we have the base case NPV, the next thing we want to do is to calculate the PV of financing effect cash flow. And I told you, whenever you want to calculate the present value of financing effect cash flow, you need to make some assumptions. The first thing you need to do is to decide whether you want to use cost of borrowing or the risk-free rate of return to discount the cash flow arising from financing. So in this case, and I also advised you last week that you should always use the cost of borrowing because the cost of borrowing is always higher than the risk-free rate of return. Therefore, in this, we are using the cost of borrowing rate of 7.5%. How do you arrive at the 7.5%? According to the question, examiner told us that the company can borrow. You are told here that currently AL can borrow at 300 basis points, 300 basis points above 5-year government debt yield rates. 300 basis points is the same thing as 100. Whenever you are given a basis point, just divide it by 100. All right. If you are given a basis point of 500, 500 divided by 100, that's 5%. If you are given a basis point of 50, 50 divided by 100 will give you 0.5. If you are given a basis point of 15, 15 divided by 100 will give you 0.15. So that's what you are going to, whenever you are given a basis point, just divide it by 100 to get the percentage. With the basis point is just a spread. All right. So if that is the case, so we are told that the borrowing rate, the normal borrowing rate is 300 basis points above the government debt yield rate. The government debt yield rate is the risk-free rate of return. And we are told, according to the last bullet point here, the 5-year government debt yield rate is currently estimated at 4.5. Therefore, 3% plus 4.5 will give us 7.5. Will give us 7.5. And that's how we arrive at this 7.5 here. That's how I arrive at that 7.5. Let me see if I have the working also for that. Okay. I did not show. So that's that. So it's 7.5. Now I've demonstrated for you how I got the 7.5%. Okay. So that is for that. Then the next thing we want to do, of course, is to determine whether we want to use the gross finance required or we want to use the net finance required. That's the second step. So we have identified or we have determined the cost of borrowing to be 7.5, which we are going to use to discount the cash flow arising from financing effects. Then the second step is to determine whether or to decide whether you want to use the net finance required or the gross finance required. And I told you that you should always use the gross finance required, except examiner says otherwise. So in our last class, I explained to you how to calculate the gross finance required and the net finance required. The net finance required is initial outlay plus working capital. In year 0, initial outlay is 21,000. Okay, the working capital in year 0 is also 731. When you add it together, that is 21,731. That's the net finance required. It is assumed that the subsequent working capital will be financed from the cash flow generated by the project. So in that case, to now get the gross finance required, of course, the gross finance required is the net finance required divided by 1 minus issue cost rates. I will need to go back to the question to go and identify information on issue cost. According to the question, we are told that issue costs are 4% of the gross finance required. So if issue cost is 4%, then in that case, 1 minus 4% will give us 0.96. Therefore, 21,731 divided by 0.96 will give us the gross finance required of 22,636. All right. So at this point, we are assuming we want to use the gross finance required. So we are not using the net finance required for cash flow from financing. So in this case, we want to calculate PV of issue costs. We want to calculate PV of issue cost. How do you do this? I told you there are 3 procedures that you are going to carry out. The first procedure is to determine the issue cost amount. To get the issue cost amount, you are going to multiply the issue cost rates with the gross finance required. Gross finance required is 22,636. Issue cost rate is 4%. When you multiply that, that's what produces the 905. Therefore, the issue cost amount is 905. 905 is the issue cost amount. Then step 2, you calculate the present value of issue costs amount in year 0. To get the present value of issue cost amount in year 0, I will go back to the question. As far as the issue cost is concerned, am I given debt and equity? In this particular question, the examiner gave us only, there's nothing like equity. Since you don't have equity, then that means you focus on the debt. Therefore, the issue cost amount on debt is 905 multiplied by the discount factor in year 0 at 7.5% at 7.5%. So discount factor at year 0 is usually 1. 9.905 multiplied by 1 will give us 905. Therefore, the present value of issue cost amount in year 0 is negative 905. Then the last thing we are going to do is to calculate the PV of tax saved, PV of tax saved on issue cost amount in year 1 only. Okay, to do this, you are going to multiply the issue cost amount with the company tax rate to get the tax saved. Then, of course, you discount it for year 1 only. So you need to calculate discount factor for year 1 at 7.5%. You will recall that I mentioned that anything you are going to do under the PV on financing effects, you are going to use 7.5%. All the cash flow from financing effect, you are going to use a discount rate of 7.5%, which represents the cost of borrowing. So in this case, I want to calculate discount factor for year 0, which is 1.075 raised to power 1 minus. That's 0.930. That's what produces 0.930. So 0.930 multiplied by the company tax rate of 25%, okay? Then multiply by 905. We got 210. So to now get the present value of issue cost, minus 905 plus 210 will give us minus 695. Okay, minus 695. I will keep that on one side. I will also go back to the question to go and identify if I'm given subsidized loan. Of course, in this question, we have subsidized loan. So we then go back to the question, where do you have information on subsidy? Examiner has told us that you are told that in the question, the government is excited about the project and has offered AL a subsidized loan of up to 80% of the investment funds needed at the beginning of the project at the rate of 200 basis points below AL's borrowing rate. So that is the information of the subsidized loan. So in this case, what am I supposed to do? First thing first, I need to calculate the interest rates on the subsidized loan. The interest rate on the subsidized loan, the examiner told us, is 200 basis points. 200 basis points below AS borrowing rate. Borrowing rate is 7.5%. We have calculated 7.5%. 200 basis points is the same thing as 2%. That is 200 divided by 100. That will give us 2%. 2% minus 7.5% will give us 5.5%. Therefore, the interest rate on the subsidized loan is 5.5%. So if that is the case, so all I need to do now is to determine the subsidy amount, which is 80% of the gross finance required. So let's go and do working for that. Subsidy amount. So the gross finance required we calculated is 22,636. That is, of course, this is the gross finance required we have here. So 80% of that is 18,109. Then step 2, you calculate savings on subsidy in percentage. The savings on subsidy is the normal borrowing rate minus subsidy rate. That is the interest on normal borrowing minus the interest on subsidy. So normal borrowing rate is 7.5%. Interest rate on subsidy is 5.5%. So we have a saving of 2%. The next step is to calculate the net subsidy. Net subsidy is the subsidy amount multiplied by savings on subsidy multiplied by 1 minus tax rates. So subsidy amount is 18,109. Savings on subsidy is 2%. Then company 1 minus tax rate. Tax rate is 25%. So that will give us 0.75. When you multiply the 3 together, we have 272. That's the net subsidy. Then the final step is to calculate the PV of net subsidy. To get the PV of net subsidy, you then say net subsidy multiplied by annuity factor of years 1 to 4 at 7.5%. Remember, anything you want to do under the PV, under the financing effects, Your discount rate must be consistent all through. It's the same 7.5% you are going to use as your discount rate. Therefore, to get the annuity factor, of course, you know the formula for annuity is 1 minus, open a bracket, 1 plus r raised to power minus n, all divided by r. So in this case, our discount rate is 7.5%. I would then say 1.075 raised to power, useful life of this project is 4 years, raised to power 4 minus equal, then minus 1 equal, divided by 0.075 equal, that's 3.349. That's how I arrive at this 3.349. Then you multiply with 272, we have 911. So 911 is the present value of net subsidy. Present value of net subsidy is 911. The last one is interest. So we need to calculate the present value of tax saved on interest. Therefore, I told you there are 3 procedures when you want to calculate the PV of tax saved on interest. The first procedure is to accumulate all interest elements. The second step is to calculate tax saved on interest. Then the third procedure is to calculate the PV of tax saved on interest. So the first one, we want to accumulate all interest elements. To get interest on the normal borrowing, the interest, you are going to multiply the gross finance required. You remember, examiner told you that 80% is attributable to subsidized loan. It means that 20% is for normal borrowing. So just borrow in the market at 20%. Therefore, out of the gross finance required of 22,636, 20% is for normal borrowing. Then you multiply interest rates on subsidized loan of 7.5%. Okay. All right. So that's what produced the 340. We also do interest expense on subsidized loan. All right. Gross finance required. We've done this before, which is 18,109 multiplied by 5.5. We have 996. So 340 plus 996 will give us 1336. That's the total interest. That's the first step. The second step is to calculate tax saved on interest. Tax saved on interest is total interest multiplied by the company tax rate. The company tax rate is 25%. So we multiply 1336 by 0.25. We have 334. Okay? So that's the tax saved on interest. So to now get the PV of tax saved on interest, all we need to do is to multiply the tax saved with the annuity factor. We've already calculated annuity factor to be 3.349. Therefore, 3.349 multiplied by the total tax saved of 334. So we have 1,119. Okay, 1,119 is the PV of tax saved on interest. Now, we have calculated for the financing effect cash flow, we have calculated PV of issue cost to be minus 695, PV of net subsidy to be 911, PV of tax saved on interest to be 1,119. The next thing we want to do is to calculate the PV of financing effect. We need to calculate the PV of financing effect. Therefore, the PV of financing effect, of course, these are the components. The first item will be the PV of issue cost, which is minus 695, PV of net subsidy, which is 911, PV of tax saved on interest, which is 1,119. When you add up everything together, we have 1,335,000 positive. So which means that the financing effect contributed 1,335,000. Okay, 335,000. So the next we are going to do, step 3 now, is to calculate APV. Remember, step 1 is to calculate base case MPV. Step 2, you calculate PV of financing effects. Then step 3 is to calculate the adjusted present value. So we calculated base case MPV to be 1,060,000. We also calculate PV of financing effects to be 1335. So you add the two together, then we have adjusted present value of 23 2395. Okay, adjusted present value of 2395. So, of course, the next thing we are going to, the fourth procedure for calculating APV is to advise. And I told you that if your APV is positive, you advise that the project should be undertaken. But if APV is negative, the project should not be undertaken. So in the requirement of the question, examiner is asking you to evaluate on financial grant whether AL should proceed with the project. Okay, since the project produced a positive APV of 2,395,000, then the project is financially viable and should be undertaken. All right. So the project is financially viable and should be undertaken considering the positive APV of 2,935,000. So this is how to calculate adjusted present value. So our assumption, we made several assumptions in this calculation. So one of it is that, of course, we use gross finance required. Okay, we use gross finance required for the tax saved arising from for the cash flow arising from subsidy and then tax saved on interest. They are all calculated on the basis of gross finance required. If your assumption is to use net finance required, you also stated there. Not only that, the PV of issue cost included tax sheet, that is tax benefit for year one only. So our assumption is that there's a tax saved, there's a tax benefit on issue cost amount in year one. Okay. So if your assumption is that there's no tax benefit in year one, you also stated there. So it's just an assumption. Okay, but at all time you need to include it, except examiner says otherwise. Except the examiner says otherwise. You need to indicate, you have to calculate for the tax saved on the issue cost amount in year one at all time, except if examiner says you should not do it. All right. So it is assumed that debt issue costs are tax deductible. Okay, there's a tax benefit associated with that. So this is how to calculate adjusted present value. It's the same procedure. Anyhow, the question is being structured. It's the same procedure. All right. It's no more than this. It's no more than this. Okay, then. Let me see if I state my assumptions in this calculation, because you can never earn your full mark. Okay, you can never earn your full mark without stating your assumption. I think in the requirement, examiner also asks you to do that. Number B, discuss the appropriateness of the evaluation method used and explain the assumptions made in part A. Okay, so even if examiner did not ask you for this number B requirement, you have to state your assumptions. You have to state your assumption for you to be able to earn your full mark. So examiner is now asking you to discuss the appropriateness of APV. Just explain what APV is all about. That's all. Explain the APV. That's all. So let me just show you how I did it. The APV appropriateness of the evaluation method used. The APV method is a technique that separates cash flow from operation from the cash flow arising from financing and appraise each independently. The relevant cash flow from operation were discounted using the cost of equity loan geared in arriving at the base case NPV, whereas the cash flow arising from financing effects were discounted using a borrowing rate of 7.5%, which is consistent with the M&M proposition. The benefit arising from financing effect cash flow was added to the base case NPV in arising at the adjusted present value calculation. That's all. That's all. 5 marks. Then, examiner also said we should state the assumptions. So you need to state your assumption from beginning to the end. All right. What are the assumptions that we have made in our calculation? The first assumption, of course, you say that the analysis on the APV calculation was based on the following assumption. Number one, cash flow. I've already told you, whenever you want to state assumption, you have to speak about cash flow. If you have inflation, you talk about inflation. If you have cost of capital, you talk about cost of capital. Any other assumptions that you have made in the question, then you need to consider it. All right. So the first one is cash flow. What is our assumption on cash flow? It is assumed that all cash flow estimates are realistic and will occur at the end of each year. All relevant cash flow have been inflated at the appropriate inflation rate. That's our assumption on cash flow. Then next is the discount rate of financing effect cash flow. You recall that I explained this in detail, that you can either assume the risk-free rate of return or cost of borrowing. But in our own case, we assume the cost of borrowing. Therefore, discount rates of financing effect cash flow. Borrowing rate of 7.5% was assumed as the discount rate for financing effect cash flow, consistent with M&M proposition, because M&M did not tell us what discount rate to be used for financing effect cash flow. Therefore, you are at a liberty to either assume the cost of borrowing or the risk-free rate of return. Then, the third assumption is on working capital. It's assumed that working capital is part of the finance required at the beginning of the project, and that any increase in working capital will be financed from the cash flow generated by the project. This can be tested by carrying out sensitivity analysis to ascertain the tolerable extent to which then present value can accommodate changes in working capital. This is just an addition to, but you don't need it. Just an addition to that. If you stop here, you're good. So that's our assumption on that. Then we talk about the cost of capital. What's our assumption on cost of capital? The existing discount rate of 12% of Alcantara Limited cannot be used to appraise the new project. This is because cost of capital should be consistent with the project risk and the cash flow. Since debt equity proportion of Alcantara Limited will change significantly as a result of undertaking the project, a new cost of capital that is appropriate has been calculated using information of the comparable company, that is Cascare Limited. All right. 1 minute, please. Sorry, let's continue. We're almost there. Let me reshare. Okay, so the next assumption is on the government 5-year government debt yield. Cost of borrowing, that is interest rate, is not given. You recall that when you wanted to calculate the cost of equity on gear, we used the information of a proxy company. So the debt of 40 million naira, the bond of 40 million naira, we are not given the interest rate on it. And we made an assumption. We assume the risk-free rate of return of 4.5% on that. So that's what I just mentioned there, that cost of borrowing, that is the interest rate, is not given for the bond of 40 million naira of Cascare Limited. Therefore, the 5-year government debt yield rate of 4.5% is assumed as the cost of debt. Then the next one is the feasibility study. So we have feasibility study of 5 million naira. So we said it's a sunk cost and therefore not relevant to the calculation. The next one is the fixed overhead. We are given a fixed overhead of 3,750,000 naira attributable to centrally allocated fixed costs. So this 60% portion of it is irrelevant because it is an apportionment and not relevant to the it's not relevant to the calculation. Then another assumption is inflation. So what do I mean by this? All relevant cash flows were inflated at the appropriate inflation rate, and it is assumed that inflation rate will not change for the foreseeable future. Otherwise, the decision to accept the project may change also. If your inflation rate increases, especially for the cash outflows, the decision to accept the project may be affected. All right. Then we talk about scrap value. We are given the scrap value of 24 million naira. Therefore, it is assumed that the cash flow of 24 million naira arising from the sale of the project to a group of young investors is appropriate and realistic. Hence, if the sales proceed is reduced by more than 6.5%, that is, in this case, I have to go ahead and calculate the sensitivity analysis of the sales proceed. All right, that's how I arrive at that 6.5. Then the project will become negative, and the company will rely on the benefits arising from financing effect for the acceptability. So I only had that one as an addition. Okay, that sensitivity analysis is just an addition. So it's not compulsory that you must do it. Of course, to calculate the sensitivity margin of scrap value is simply NPV over the present value of the scrap value. Okay, so that is that. That is that. Then lastly, I talk about the gross finance required. The present value of issue cost, subsidized loan, and tax saved on interest were calculated on the basis of gross finance required. And it is assumed that tax sheet will arise from the issue cost in year 1. So all these are the assumptions I made in the calculation. Of course, it's not compulsory that in your own case that you have to state the entire thing. But what is important is that all relevant assumptions that you have made in the question, you have to state it, you have to indicate it in your calculation. Then the last part of the question, examiner wants you to state the ethical issues. All right. You have to provide example of ethical issues that might affect capital investment decision and discuss the importance of such issues for strategic financial management. This has to do with something is not about calculation in this case. Any ethical issues that relates to investing decision is what you are expected to state in this circumstance. There are so many issues that you can talk about. You can talk about quality, talk about health and safety of employees, as including the project manager and all of that. Talk about sustainability, environmental issues. Talk about corruption, okay, corporate governance. Talk about taxation. Then talk about the conflict of interest. Okay, conflict of interest. These are ethical issues. When you just talk about few of them, maybe 5, and you are good to go. All right. I don't want to. You have this material, so you can just go through it and Yeah, that's it. So, yeah, that's it. I think that's end of the question. That's end of the question. Let me know if you have any question for me, please. Any question for me so far? Some of you have disappeared. Okay. Mr. Robert did not join today's class. Yes, any question for me before we close the class? So in our next class, we are going to portfolio theory. So just go ahead and read about portfolio theory. And before that, please ensure you go through other examples you have in this material. For those of you that have it, if you don't have it, then go to ICAN Pathfinder question and answers. Try other examples there. All right, go and try so that you well grounded on APV, because you never can tell. It may come to you as a compulsory question, just like in this one. It was a compulsory question. I think in 2016 or 2017, APV was tested. In 2019, it was also tested. So since that 2019, ICAN has not tested the APV. So you never can tell. It may be a compulsory question, this diet, so you don't know. And that's why you don't ignore any topic. No matter how difficult is the question or is the topic, just try your best to have the understanding, because you don't know. It may be and you cannot ignore a compulsory question. You just have to solve it. All right. So try as much as possible to read further. All right, especially the one that involve equity and debt. Question that involve equity and debt. I think I have example of that in this material. Let me see. In this particular question, this one is an ACCA question. In this one, I use the net finance required for financing effect cash flows. All right, I use net finance required. So in case you want to know how you are going to treat it, how you are going to treat net finance required, if net finance required is used. So this example number 3, the illustration number 3 is a good example of net finance required. All right. Then let me see the question that I think I have a particular question that involve both equity and debts. But yes, this is the question. This question number 3, illustration number 3, involve equity and debts. Traposka, yeah, involve equity and debts. Let me see. What did the examiner says? So you can just go and master, especially this illustration number 2. Go and master it. So it's very straightforward. It's the same thing as what we have done, except that this one involved both equity and debts. I want to see the information on equity. Issue costs. I want to see. Let me go back to the. Okay. Issue costs. Yeah. Okay. This is not the one that involves issue costs. So this is not the one that involves equity, both equity and debt. I think it has to be illustration number 2 then. Let me check. Illustration number 1. Yes, it is this one. So you can see. Let me go to where I have information on issue costs so that you see how you look at the information. You are told that assume that the debt is risk-free and that the risk-free rate of return is 10%, while no, that's not. The financing information include the new investment will be financed as follows. The venture that is redeemable in 3 years' time, 40%. So debt is 40%. Right issue of equity is 60%. So in this case, what you are supposed to do, and then examiner has given to you the issue cost rate to be 4% of the gross equity, then 1.5% of the gross debt. So assume that the debt issue costs are that tax deductible. That is, in year one, you have to calculate the tax saved on the issue cost amounts for year one only. So in this case, what you are supposed to do is that, of course, you are going to take 40% of the debts of the net finance required. 40% of the net finance required as debt, then 60% of the net finance required as equity. Then you now gross it up using the issue cost rates, okay? And that's what I did here. Let me show you, just in case. Let me show you. Yes. So calculating gross finance required. Totally raise the finance through a mix of equity and debt. Therefore, the initial investment of 8 million naira net should be grossed up for each equity and debt separately after taking the proportion of each from the amount needed. So the net finance required is 8 million naira. There's no working capital, so it's 8 million naira. If you have working capital, you add it to the 8 million. Then out of this 8 million, net finance required, so 60% is for equity, which is 4.8. Then 40% is for debt, which is 3.2. So to now get the gross finance required, of course, you know the formula. You are going to do it separately for equity and debt. The net finance required for equity is 4.8. The issue cost rate of equity is 4%. Therefore, 4.8 divided by 0.96 will give us 5 million naira gross. You do the same thing for the debt. The net finance required on debt is 3.2. Then you divide it by the 1 minus issue cost rate on debt. You have a gross finance required of 3,248,731 naira. So this is the value that you are going to use to calculate your issue cost, PV of issue cost. Okay. So that's what I've done here. That's what I did there. You can see that I calculated present value of issue cost separate to be 209. Present value of issue cost on debt separate also to be 49. All right. Then you now calculate tax saved on issue cost on debt. Tax saved on issue cost on debt in year one only. And that's what produced the 13. Okay. So you have the total PV of cost, total PV of issue cost to be 239. So this is how to treat it if you are given both equity and debt for your issue cost. All right. So this is the end. This will be the end of the class. Let me know if you have any question for me. If not, just close the class. All right. So thank you for your patience and then understanding. I will see you next time by the grace of God. Don't forget what I said. Please, 2 things. You need to go ahead and try more different examples on issue cost. Try different examples on issue cost. Then 2, in our next class, by the grace of God, we are going to be having the projects. So we are going to be having portfolio theory. So go and study portfolio theory ahead of time. Thank you guys for your time and understand. I will see you next time by the grace of God. Good night, everyone.